guys, welcome back to the channel. Today I'm going to give you an update on the UK economy. If you watch my channel regularly, you know that I give a monthly update on the property market, but sitting behind all of that is what's going on in the UK economy. It's important to know how the economy is behaving because that has a direct effect on the property market. So without further ado, I'm going to take you through what's going on. I'm going to show you a few key aspects of the economy. I'm not going to focus on all of this, just a few. Those being the GDP rate. I'm going to explain what these are as I go along. Interest rates, inflation, and also the money supply. These four metrics, guys, have a direct, big impact on the property market, and I'm going to take you through how. I'm going to keep this video very simple and go through each one in turn. So let's get straight into the first metric, which is the GDP growth rate. Now, what is GDP? There are three ways of measuring it, but the one that I prefer to go by is the value of goods and services produced in an economy. So when this number is rising, the economy is said to be doing well, and when it's falling, it's said to be heading towards recession. Economists and governments alike tend to use GDP as an indicator of how well the economy is doing. It's like taking the temperature of the economy. And in terms of what is a good level of growth, most economists tend to agree today that between 2.5 and 3.5% GDP growth per year is a level of growth that an economy can safely maintain without causing negative side effects like a recession or inflation. So how has our economy been doing over time with regard to GDP growth? Well, this graph right here tells us everything we need to know over the last 3 years since July 2018. Now, each bar you see represents 3 months, so these are quarterly. Now, what I really want to focus you on is these 1, 2, 3, 4, 5, 6 bars, which represent 18 months. Now, what has happened over the last 18 months? Oh, I don't know, a global health crisis. And you can see that these bars swing wildly in opposite directions in line with it. So let's explain them. These 2 bars here are basically the first half of 2020. And we all know what happened in the first half of 2020. We were all locked in our basements. Well, maybe that's a bit dramatic. We were all under lockdown in our homes, working from home, wearing face masks, everything was shut, people were on furlough, people were losing jobs. The economy, society, and businesses and workers were heavily disrupted. And correspondingly, we saw the greatest drop in GDP for over 25 years. If we just go to the 25-year view, you can see there, this is the same bar, but just as a line graph instead. There is no drop equivalent to this for the last 2, probably 3 decades. If we max out, in fact, there you go. 1963, well, even longer, even longer than 25 years, guys. We're going all the way back to 1963, and I'm sure beyond that, there hasn't been a drop bigger than this. So we're talking over 60 years, guys. But let's go back to the 3-year view. So the first half of 2020, as a result of the global health crisis, plunged us down into record negative growth. Then in the second half of 2020, as things started to go up, again, you see this huge swing upwards, 16.9%. So I want to go back over the 25-year view. Sorry, let's max out actually. You can see again, over the last 60 years, 60 plus years, there hasn't been a level of growth equivalent to that. It's record growth. Now, why is that? So this is explained by the fact that because of the global health crisis, we saw a record fall. And then essentially, once everything was opened up again, that lost growth was recovered and therefore a huge swing back upwards. Think of it like being in a 100-meter sprint. So imagine you gave everybody a 3-second head start. So after 3 seconds, you're behind everyone and then you start running. And because you're Usain Bolt, you're going to catch up with them very quickly. This is essentially recovering lost economic growth. And then coming into 2021, there was another lockdown, if you remember, just before Christmas into the first part of the year. So again, some negative growth, and then things opened back up again. So you can see basically that the economy mirrors what's going on socially. Now, the question is, how does GDP, we need to link this back to housing, guys. How does GDP link to housing? Why is it important to keep an eye on what's happening with economic growth? Simply put, guys, when the economy is booming, so we're talking about consecutive sustained positive GDP growth, that has a knock-on effect on the housing market, and you usually see a correlation between the two. You usually see a rise in house prices in line with economic growth. So what does that mean for you as a buyer or an investor? Well, as a buyer, you're probably going to be paying higher prices for houses because people have more money in their pockets, they're more optimistic, they feel richer, and so house prices are driven upwards. And that might mean that you're able to use certain strategies like flipping, for example, because you can buy a house house, and you'll be fairly confident that once you've added some value to it, that and also the general increase in the level of house prices are going to mean that you can turn it around and sell it relatively quickly and make a profit. Conversely, during times of negative GDP growth, you might hear other words used such as a recession, a contraction in the economy, a downturn in the economy. It's all the same, guys. House prices generally fall, and a lot of people assume that that's a bad time to buy a house. Think again, guys. It's actually an excellent time to buy a house because the reverse is happening. People aren't trying to buy houses. House prices are falling. Most people aren't trying to buy houses because they're not richer, they don't feel richer, they're more pessimistic about the economy. That is a great time to buy houses at a discount, guys. It's like when a shop puts on a sale and you can get stuff at cheaper prices than you normally would under normal conditions. Me personally, guys, I'm trying to build up my reserves, and I'm really just waiting for the next economic recession so that I'm ready to jump into the market and buy at low price points, because a lot of houses are going to be undervalued during these periods, guys. So that's GDP in a nutshell and how it affects housing. Now next, let's talk about money supply. This is a big one, guys. The supply of money in our economy has a huge effect on property prices. In particular, I'm going to look at the measure called M3 money supply. What is that? So M3 is known as broad money, and what that is, it's the broadest measure of money in an economy. It includes physical currency, so coins and notes. It includes assets, liquid assets held by banks, and also it includes other assets that can be easily converted into cash to buy goods and services. So that's broad money in the economy. Now, how is money linked to housing? Well, guys, to answer that, I want to talk about quantitative easing. Now, quantitative easing is where the Bank of England will buy bonds, government bonds, from financial institutions, mainly banks and insurance companies. And as part of that exchange, what you have seen in the UK is billions of pounds being handed over to these companies in exchange for buying those bonds. And the hope is that those billions of pounds going into the economy from the Central Bank of England via these financial institutions, the hope is that that will stimulate the economy. I notice I use the word hope, guys, because they can't control this, but what they expect is for these banks to lend this money out to normal consumers in the form of loans and other type of credit products. Also, perhaps to give their employees wage increases, employing more people, expanding their business operations. They really use the financial sector as a conduit to stimulate the economy. Now, does this actually happen in practice? Well, there is a lot of evidence showing, guys, that when QE happens, the prices of property hike upwards. Now, why is that and how does that happen? Well, instead of lending out significant portions of that money, what these financial institutions do is they keep that money on their balance sheet and they buy assets, and very often those assets are share buybacks, so they buy back their own shares, and property, guys. They'll invest in commercial and residential property. So you have these big, huge institutions pouring hundreds of millions, maybe even billions of pounds into the property market, and that raises a general level of prices in the market. So essentially, if you bought a property, say in 2008, before quantitative easing began in the UK, if you look at the price hike between 2008 to 2020, where the government has pumped just under 900 billion pounds into the economy, you will see an equivalent rise in house prices. Now, I'm not saying the rise is completely due to quantitative easing, but it is a big part of it, guys. So let's have a quick look at how the M3 money supply has changed in the UK over time. Now, this is a 5-year view, and over those 5 years, the government has pumped round about 550 billion into the economy. And you can actually identify where some of these hikes were. I've zoomed out to a 10-year view because it's a bit more clearer here. Now, in August 2016, the government pumped 70 billion into the economy. And you can see round about here, you see this hike right here, that is correlated and corresponds to when the government pumped that additional money into the economy. And then if you zoom forward to 2020, during the global health crisis, over that period, the government has pumped an additional 450 billion into this economy, into our economy. And again, you can see it quite clearly there. The first pump, as it were, was in March 2020, so the beginning of 2020, and they did that all the way through until November 2020. So, you can see a clear hike in the supply of money in the economy. And correspondingly, the average price of a property in the UK has risen from 180 185,000, call it 186 in January 2008 to £265,000 today. That's just under a 50% increase in those 13 years. So good growth. So that's really a short and sweet summary, guys, of money supply and how it's connected to house prices, and how economic shocks and the corresponding QE pumping of money into the economy isn't necessarily a bad thing if you own property. These measures by the government can actually work for you guys. And then lastly, guys, let's look at interest rates. Now, what is an interest rate in this context? We're talking about the Bank of England base rate, which is basically the official UK borrowing rate. So banks will base their savings rates and their loan rates and their mortgage rates off of the Bank of England base rate. This is a rate that they take their cues off of. And you might have heard the term monetary policy, but essentially the Bank of England will use interest rates to manipulate the economy. So they will rise interest rates often to prevent inflation and the economy going too crazy. Think of Zimbabwe. And they will lower interest rates, as they are right now, to try and stimulate growth in the economy and to see the GDP number that we looked at first of all rise over time. So let's take a quick look at interest rates over the last 25 years to get an idea of what's happened in our economy. So you can separate this graph into two halves, and you can see that it changes from 2008 onwards. What happened in 2008? I think we all know. We saw the global economic crash, the last great one. Prior to that, the economy was in a boom. The housing market was absolutely booming for people who can remember as far back then. And interest rates, you can say, roughly oscillated between about 4% and call that, I don't know, 7.5%. So it was in that range. Now, as we said, when the economy crashes, the government will lower interest rates to try and stimulate the economy. And what we saw at 2008, when the economy crashed, the government immediately reduced interest rates to sub 1%. I think that's 0.75%, and it's really remained there or thereabouts with a slight hike there ever since. For the last 13 years, guys, we've had incredibly low interest rates. And right now the interest rate is at 0.1%. Why? Because we've just come out of a global health crisis and the government is desperately trying to revive the economy. So what does that mean for house prices, guys? Well, imagine you are looking to buy a house right now. Borrowing is cheaper than ever. It's cheaper than it has been for, well, the last 13 years, guys. Assuming that you qualify for a mortgage. Now, mortgage criteria, acceptance criteria is a separate topic, which I might cover in another video. But essentially, it's where the bank screens you to make sure that you're able to repay, that you're earning enough money. If you're looking at a buy-to-let, that it's going to generate enough in rent to repay the mortgage. But essentially, it's qualifying you as an eligible borrower. So let's assume that you do qualify. Getting a mortgage now is ideal if you have the money, and if you're able to get a rate at these record lows and fix it for the next 5 years, maybe even 10 years if you're lucky, you're in an excellent position compared to, say, 15 years ago in 2006, where rates were at 4.5% and above. It was much more expensive to borrow. That doesn't necessarily mean that the housing market was suffering. In fact, quite the opposite, guys. The economy was booming pre-2008, as they are now, by the way. So the market isn't necessarily driven by interest rates. It's driven really by demand and supply and availability of credit. However, as a borrower, if we talk specifically as a borrower, if you're looking to build your portfolio, if you're looking to just buy a house in general, now is a great time to lock in a good rate and be fairly certain that you're not going to see rates as good as these for a good while. So guys, this is the economy. This is an initial video. I wanted to keep it simple, focusing on GDP, economic growth, money supply, and interest rates. I could broaden this out to things like inflation and unemployment, but I think these are the key metrics that I want to focus on for now. Let me know if you found this video helpful, and I'll see you guys soon.